We're here to talk about Silicon Valley real estate marketplace through midnight on Friday, April 11th, reported Saturday, April the 12th. Here are the key chapters. You can jump to the chapter using the timestamps in the YouTube description below. Let's just jump right into the data slides. Here is not where I normally start off the data with, but it summarizes what's going on. Here's your inventory. Across the board, it's up significantly from just last week. At the same time, offers are down across the board, with the exception of being the Central Valley. Both San Joaquin County and Sacramento saw an increase in the number of offers, which contradicts the other areas. The days unsold inventory, which is the supply-demand balance, here I usually raise the red flag anytime I see 5 days or more in a week, and we're seeing across the board 5-day increase, which is a slowing marketplace everywhere except the Central Valley, which actually saw a half day. So that's the story for the week. As active listings went up significantly, sales offers accepted went down significantly, and the DUI lane increase, which is a slowing of the marketplace. Let's get into the normal presentation. Here's the summary slides. Here you can see inventory. This is this current week right in the center. So you go back 13 weeks, which is a quarter. You go forward 13 weeks. Not that I have the data or even an estimate for the data, but you can see the trends. The gray line is the 10-year median. The blue line is the 90 or 10 percentile that favors the buyer, because blue is a nice cold buyer's marketplace. And the red is either the 90 or the 10%. It's a red hot seller's marketplace because it favors the seller. A lot of inventory clearly favors the buyer. They have a lot of choice, less competition. And you can see that we're now above the blue line. We started off the quarter just 13 weeks ago. We were basically right at and actually below the gray line. We only had 89% of the inventory you'd expect, and now you're at 137%. So your inventory has gone up by basically 50%. At the same time, your offers have gone from 69 to 79 and have only gone up by 10%. So a huge shift. The most you had a buyer's marketplace, the blue line would have been at 26.29. We're actually at 27.58. So we have 130 more listings than you would expect to have even in a slow marketplace. The red would be a shortage of inventory. Moving on to offers, you can see offers started off at 68%, 69%. It's now at 79%. So it's 10% growth in the number of offers, but that happened at the time that inventory went up by 50%. Huge difference there. You can see that you were below the blue line. You actually came up and were between the blue and the typical, and that's where you stand now. But the big takeaway is this last week, we went down a little bit, even though the market normally is going up. Keep in mind also that, there's obviously been a lot of changes in the last 10 days in the economy, but keep in mind that I'm looking back 35 days. So a lot of my data predates the recent upheaval that started on April the 2nd. So the robust marketplace would be 30,000 offers accepted. We only had 2,000 offers accepted, 2,100, which is halfway in between the sluggish marketplace at 1,700 and a typical marketplace at about 2,670. So clearly a lack of offers. Number of transactions is just on there for giving you an idea of how many are closing. We are sort of in the same position as the offers. Were close to the blue line, below the typical line. So less transactions overall than normal. In fact, it's 84%, 85% of the normal level of transactions. Going on to days unsold inventory, this is a seller-buyer balance, the supply-demand balance. You can see that we were basically tracing the blue cool marketplace, and then we curved over and got above it. Now, when you look at this, it looks fairly close together, but look at the numbers. You went from 14% slower than typical to 63%. So you're now 50% more slower than you typically were. So even though it looks like it's close, 50% is pretty significant. On days unsold inventory, you're now at basically 46. The slowest marketplace we would have expected would have been 39. So we're basically 7 days slower, a full week slower than the slowest you'd expect for this time of the year. Typical is at 28, so we're approaching 2/3 slower than you typically are. And the quickest marketplace would have been 17 days. And that's the time that it takes to sell out your existing inventory at the existing rate of sales. If there's no new inventory, it's your turnover rate. Days on market, 75th percentile. I used to be a fan of this until I realized that the shift between the year, basically going from the typical line, say here in week number -8, call it, to here is greater than the variations between it. So I'm not sure it really helps that much, but we are 5% slower, longer marketing times at the beginning of the quarter. We're only 16% slower now because you're at 18 days instead of 16. It's very tight, and you can see it even gets tighter as we get into the future weeks. So even though this looks like a horizontal blue line, it's actually been crossing over because we were started off the year below the red. So we actually had a faster than normal, significantly faster than normal marketplace here, marketing time. Then you got to typical, and now you're above typical. One of the reasons this isn't such a valuable number is it only includes the sellers' activity that were successful. So the sellers that are overpriced and this marketplace rejects them and they are on the market and then leave the marketplace and without selling, they never count in this data. So that's one reason this number is so small. And it also tells you, and we'll see it later on in the presentation, that using the 75th percentile is a lot smarter than the median or the average. Price cuts. This is the seller's price reductions. We were only at 0.9%, so it sounds very small, but believe it or not, that was 5% more than normal, basically at the beginning part of the year. Basically, what would it be? We're the second week, so it would have been the second week, it would have been January 10th. Now we're taking 0.7% price reduction, so we're taking less of a price reductions, but percent of normal now is approaching 400%, 370, 60% more than normal. So that's 3.6 times the normal level. And the reason for that is typical is down at here at 0.2. So your normal level of discount at this time of the year is very, very minimal. And we're obviously approaching 4 times that amount of discounts. And then overbidding is a lagging indicator, but instead of getting closer to the red line like we had been, we are now pulling away from the red line and getting close to the typical. We're basically currently at 0.4% overbid. We typically have 6.9% overbidding. So you can do the math and see that that's 1.5% more overbid for each seller than typical. And that's the percent of the seller's house price. And again, not only do I look back in the rearview mirror 5 weeks, I can't report the data until the escrow closes. So you have the lag time of the escrow plus 5 weeks of back data. So anything that happened recently is not reflected in overbid data at all. Moving on to see the Silicon Valley. So now we're just focusing in on Santa Clara, San Mateo, and Alameda counties. We're looking at the 3 components. We're looking at inventory. That's the purple line. Look at what we've done. We've gone from 73% of the expected level of inventory back here on January the 3rd to some number now around 137% on April the 12th. So that's a huge slowdown, and it's very steep. And it's 13 weeks in duration now, actually now 15 weeks in duration. The next indication we have is the number of offers. And you can see the number of offers were 70%, actually 68% of typical, got up to 90% of typical about 5 weeks ago. And now we're down here at 79%. But look at the rate of drop of this. And I drew in the horizontal lines, and you can see, you know, a number of offers is in line with the past 2 years, but 2023 and 2024 are basically the worst years we've had, and they're nowhere close to where we were with volume of sales before the pandemic. Moving on to the last indicator, the gray line, the days unsold inventory, which is the turnover rate or the ratio between the active inventory and the offers. Look at the skyrocketing increase here. And both on inventory, the purple line changing, going back to the inventory for a second, you can see the only time we had more inventory was right at the end of 2018 and the very beginning part of 2019. And this is a percentage of normal. It's not absolute numbers. But now let's look at days of unsold inventory. The only time that the market was this slow compared to where it normally is based on a 10-year moving median was during the pandemic immediate shutdown when we couldn't even show houses. So the market right now is slower by the greatest amount that it ever has been in the last 10 years, excluding the bizarre lockdown we had initially with the COVID. This is looking at active inventory for just the three areas being Santa Clara, San Mateo, and Alameda counties. Again, you can see just like on the previous chart, this is raw numbers. You were down here at about 900 active listings at the first of the year. We shot up and we're now at about 2,775 listings. And the blue line would be the most you'd expect. And so that shows you that we're above the blue line and have more inventory than we would expect. Typical is way down here, some number around 1,700. So we have almost 1,000 more listings than you would expect for this time of the year. Here's based on percentage of normal. And again, I put in the horizontal line. So you can see the only time we had a greater percent of normal inventory was right here at the end of 2018 and the beginning of 2019 when we were having a slowdown. Now that slowdown was triggered mostly by Santa Clara County that had 2 rounds of appreciation in 2018. It was sort of a bizarre marketplace. Here's the number of offers accepted compared to the 10-year median. The 10-year median is the gray line. The current line is the purple. The green line's in here to highlight the fact that back here, the x-axis is 1/2 the distance over here. I blow it out so we can see the trend changes for the last year and then the current year as well. So you can see that we had very low offers. We were basically tracking the least number of offers you'd expect. And then we actually started to improve and pull away from the blue line. But now we're just like the blue line turned back here, we've turned and we're coming back down and we're headed towards the blue line fairly rapidly. There's no way to know on how long that will continue. Here is the percent of normal. We pull out that gray curvy line and make it straight. Here's where you have more offers than normal right after the pandemic when everybody's housing needs requirements changed. Then we had the 2022 correction when sales volume went way down, in 2023 and 2024 have been basically the record low years. And that's compared for the last 25 years that I have computerized data for. Here is Silicon Valley days unsold inventory. Same concept. You can see the abrupt turn and we're going up, which is the bad number. You want this number as low as possible for a hot marketplace. So you're above a cold marketplace and going away from that cold marketplace, and you're somewhere around 46, 47 days of unsold inventory at this point. And typical is 30, so you're 50% slower than you typically are. Typically, we'd be selling everything out in a month at this time of the year, and now it's taking a month and a half. Here's compared to normal, so we're at the highest percent. In fact, what is that? That's about 64%, 164%, so you're almost 2/3 slower than you normally are. And you can see the only time we were slower, as we also saw in one of the early slides, the only time that was worse was right there when we were doing the lockdown shortly after the pandemic was announced. Here's the marketing time. This is only successful sellers. You know, and this, I thought this would be a real good indicator, but it really isn't. And I'm getting less interested in it all the time. But a couple things that are interesting is look at the purple line. It should peak right at the end of the year. In fact, it peaked on December 27th, I think it was, based on my reporting periods. And then, you know, where normally the gray line is peaking somewhere halfway through first quarter, so only about 7 weeks ago. Then we came down and now we bottomed out a whole quarter early. Well, there's almost 13 weeks difference between this bottom and this bottom, and we're already slowing down, and we've now gone from hotter, faster than the red market, a hot marketplace, to equaling the gray typical marketplace, to now cooler than normal. Here is pulling out the gray line and looking at it, and you can see the huge shortage where we were moving faster than we were typically. And basically, this was the fastest market we had. The only time it was faster was 2022, and it wasn't even much faster. And then all of a sudden, everything changed, and boom, up it came. I believe in both marketplaces, the 2022 and the current marketplace, the market started to change around Valentine's Day of each year. This is the largest price reductions. So you look at where the 90 percentile is, the seller that's where only 10% of the sellers are taking larger percentage. What percent reduction are they taking? And you come over here and the number would be 89. So that's 11% price reduction. You can see that typically you're going to be up here at somewhere around 7% price reduction. So you've gone from 7% to, what did I say? This was an 11% price reduction. So 50% larger price reductions. This is the magnitude of the price reduction. And the reason I look at only the top 10% of the sellers of the 90th percentile is so many, and it's roughly 85% of the sellers do no price adjustment whatsoever, and adding in a bunch of zeros just reduces the number. Here is the compared to typical. And again, you can see I've drawn in the horizontal line. You can see that we're taking some of the largest price reductions. The only time that we took larger price reductions was in that price adjustment of 2022. And when the market does go through a change for whatever reason, that is when you were going to see most of the price reductions. And the reason for that is pretty simple. It takes time to go through the pipeline. Agents need a listing agreement, pick a price based on your looking in the rearview mirror. By the time you get on the market, your rearview mirror has moved and your price is set. So that's why I'm a fan of adjusting the price right as you're going on the marketplace, because a lot of sellers coming on the market right now are going to be coming in based on what the market activity was like 2 and 3 weeks ago, and they're going to find out that they're missing the mark completely. Here now is looking at the average. I include this just to show why I prefer the 10 percentile. You can see that we're talking about 0.6% price reduction. You know, for the current number, it'd be about 0.7%. So the average, the average seller is reducing their price less than 1%, and that might not sound like much, but you can see that typically you never reduce a full percent, and that's why I prefer looking at the 90%. I put this in just so people can see I'm not picking the 90 percentile to say anything unusual. It's just I think it's easier to see the market trends, and you can see the huge annual cycle. That's why I put everything on here. I'm putting on 10 years so you can look at it, and that's also why I do a moving average, a moving median for the gray line, so you have some idea where the market should be. Here's compared to typical, so we search out the line, and you can see that we're taking some of the bigger price reductions. We had slightly larger percentage price reductions in 2023, very early on. That was just before the market started to improve again, and then also beginning in 2019. This has the appearance of going down for quite a little bit longer. The real question is, when is that going to break and then turn around and go back up? It's not going to be anytime soon, I don't believe. Here's the frequency. So how common are price reductions? You can see we've broken the less common than normal. Normal, again, would be the gray line. So we were taking fewer price reductions. We crossed through it, and now we're taking more, and we're headed quickly towards the blue, which means price reductions, sellers ask price reductions are going to become more common. Here's the frequency compared to normal. So here you can see the normal line stretched out. You have those same 2 periods where you had larger price reductions. So we're not as common as we have been, but we're headed towards that territory. Here's the magnitude of overbidding. Now keep in mind, I've already said it, this lags behind. It lags behind by the length of duration plus the 5 weeks that I'm using to get reasonable data. But you can see that we've turned the peak, and we went up last week and we're back down this week. So, you know, the magnitude is still more than normal. Normal would be down here somewhere around 5%. And up here, you're at 6%. This is for all 3 counties combined in a blender. And next is pulling the gray line out. You can see that we got hotter, and now we're cooling off. We're still hotter than normal, but we're headed back towards normal. And normal would be 0. Right now, we're about 1.5% higher overbid than you would expect. This is the frequency of overbidding. You basically are kissing the gray line, so you're exactly normal at this time of the year. So not more frequent or less frequent. And here you can see you went from more overbidding than typical. We were somewhere around 14% above typical overbidding. We're now at 100%. And again, you have a fairly steep decline that will probably continue. Here's pricing. I had only the long-term appreciation line in there, which I think is reasonable, and that's the 10.9%. We clearly had a higher rate of appreciation, probably around 12.5%. And now in the recent times, we're somewhere closer to 3.3%. So the last 3 years have been fairly flat on price. 3% is not bad when you're leveraged out, as most typical buyers are. 80% loans, so you pay the bank, but you get 100% of that appreciation. Here now is looking at the distribution of days on marketplace, so you can see not only what's happening down here at the median, which is a good indication of why I don't use it. The lines all converge to a very tight number, especially if you're looking at whole days, which the median would tend to do. It really doesn't tell you any gradients of the marketplace. Coming up here at the 75th percentile, the gradients are a whole lot bigger. And the concept here is the purple is the current line, but we're going to start off on the dotted bold line down here, and that's a year ago. I use a fiscal real estate year that starts on March the 1st. That's when I gather the data. I look back in the rearview mirror 7 days. I move my data gathering day forward 7 days at a time. It brings me around to February 21st. I then add 8 days to get back to March 1st instead of 7 days. And that way I'm comparing the same days all the time. The reason I picked a March 1st calendar year has to do with leap year. That's February 29th. So by taking the data on March the 1st, I then can reset and only have one discontinuity, and I can compare the same days of the year to the same days. Works out really well for holidays like July 4th, New Year's, Christmas. It does not work out so well for Monday holidays, but nothing works out well for the holidays that move around, like Thanksgiving that moves by 1 week, and then Easter moves by up to 35 days. And the reason it impacts the data is every holiday negatively impacts sales activity, except for Mother's Day and Valentine's Day, which both have a slight positive impact. But what we're going to see is we're going to start off and we're going to go a week at a time for 5 weeks. Then we're going to jump 2 weeks at a time until we get up to 5 weeks ago. Then we'll jump a week at a time. So let's go through there. You can see the market improved, and then for 2 more weeks before it started slowing down. And it's slowing down and continuing to slow down. And now you're basically in the summer doldrums, I call it, where you're not really moving very much in any one direction. You're basically bouncing. We stay there until a little after Halloween, and then we rapidly go up. That was the peak of the marketplace right after the first of the year. And this year, we've already started slowing down. See, the lines are going up a little bit. See that big jump, and then there. The marketplace is already slowing down, even though last year the marketplace improved for a couple more weeks. Same concept for the largest price reductions. You can see that last year we were up here on the dotted line. Currently, we're down here on the purple. Clearly, much cooler marketplace, which means larger price reductions. But again, we're going to start off on the dotted line and go forward. There's a week, 2 weeks, 3 weeks. So you basically have 2 more weeks where you'd expect less price reductions. But again, when we get to the end, you're going to see that this year's already turned around and larger price reductions. So you're coming up on the coolest marketplace right about here, right there, probably. And now you're heating up. And that's the hottest for this year. You've already cooled off 1, 2, 3, 4, 5, 6 weeks. So last year you had 1 or 2 more weeks of slowing down, and now you've already had 6 weeks of slowing down this year. So we're clearly having sellers do price reductions earlier in the calendar year than they typically do. Here's overbidding. So this helps buyers out. The median would be the 50 percentile right here. So you're somewhere around 6%. You can also figure out what the average overbid is, but you can see the distribution. Some people are up here paying 30% more than the seller's ask price, but there's also a percentage of the buyers down here that are knocking off 6% off the seller's ask price. Where you're horizontal right here, that's the sellers that are getting exactly their asking price. So you can get a whole idea of what's happening. The concept's the same. We stepped through getting hotter and hotter overbidding. There's sort of the peak for the year last year. Now you're going down towards the summer doldrums. And this is lagging by about 5 weeks because of the duration of escrow. So instead of being shortly after Halloween, it's going to be shortly after Thanksgiving that the price really changes. So it's going to be coming up there. and that's probably the coolest for the year, and then you're already accelerating. And right now we've already hit the peak, so we're just bouncing right at the peak. Here now we're starting a different concept. We're now looking at the 3 counties. We're looking at Alameda County in the gray that has the most inventory. Santa Clara County has the next most, the middle number, and that's in the blue. And the area that's the least inventory is San Mateo. Now, the size of inventory is mostly the size of the population and housing marketplace in the county. San Mateo County is a much smaller population-wise than Alameda and Santa Clara. You can see historically that Santa Clara and Alameda County are fairly close together, except for in 2017 into 2018 when we were on fire in Santa Clara County. Here's looking at the offers accepted. Notice the last turnaround over here, fairly significantly pronounced in Santa Clara County and in Alameda County. San Mateo County is pretty flat, and as I pointed out with the table we started off with, the Central Valley actually had an increase in the number of offers accepted. So not every county is moving the same way, and that actually was interesting to discover that, because I was trying to put together a presentation to really talk about the impact of the tariffs and the economy and the stock market, and I was including the Central Valley, and that went in the opposite direction of the Silicon Valley. And I was doing that because I was going to try to look at 1 week data, and the data, you couldn't tell anything. It was muddy water. Here's days on sold inventory. All 3 have gone up, so that's a slowing of the marketplace. Alameda County looks like it's gone up the greatest number of days. It looks like it's gone up from 48 to 58, so an increase of 10 days. Meanwhile, Santa Clara County has gone from 32 to 38, so an increase of 6 days. And San Mateo County looks like it's gone from 37 to 40, so only an increase of 3 days. Here's marketing time. San Mateo County has actually improved, which is another indication that the market's not all that good. It's not that good. And another reason, even though I'm using the 75th percentile, you can see the step functions here. You would actually want a slightly higher percentile to get rid of this, to get a smoother curve. But anyway, your marketing time in general is increasing. I think San Mateo County probably will reverse fairly soon. This is magnitude of seller price reductions. It looks like we're going down, but the down is price reduction. 100%'s up here, 1% is here. So going from 0% to 1% is more price reduction. So both San Mateo County and Santa Clara County have fairly significant increase in price reductions. Alameda County actually went the other direction and took a little bit less, but that's only about a half of a tenth of a percent roughly. Here's the frequency of those price reductions. So they're going up in Santa Clara County, they're going up in San Mateo County, and they've gone down very little in Alameda County, but it still remained that county that had the most common amount of price reductions. And it's still not that common. You're talking about basically 12% in Alameda County, and you're talking about 11% in San Mateo County and about 10.5% in Santa Clara County. This is the magnitude of overbidding. You can see that Santa Clara County probably rolled over the first and it's come down the most. Alameda County in the gray rolled over next, and San Mateo County was the last to roll over, and looks like it maybe has finally rolled over. Frequency of overbidding, frequency is still going up in San Mateo County, so the magnitude clearly is coming down. And then in Alameda County, it's down, and in Santa Clara County, the frequency is down. So overbidding is becoming less common, but all 3 are very close together at about 73, 75% of the sellers are getting more than their asking price. But again, I need to keep saying this. That's 5 weeks ago because of the duration of escrow, plus another 5 weeks because of the way I gather data. Here's the long-term appreciation. Santa Clara County has the highest appreciation at 220%, so 120% appreciation. You can see last week was a little bit higher in price. Then San Mateo County and Alameda County are essentially tied at about 82% appreciation. And the appreciation has been measured since the last 9 months of 2015. Here's the sale price. The lines here are merged because coincidentally, the 2 counties, San Mateo County and Santa Clara County, have exactly the same median sale price this week. It's $2,120,000. So $120,000 over $2 million. They're together, so that's why you're seeing one solid line instead of two dotted lines. Alameda County is there, and I also have the horizontal line so you can see Alameda County is below their 2022 peak. San Mateo County is below their 2022 peak, but Santa Clara County is significantly above their 2022 peak and even above their 2024 peak. So Santa Clara County is at record high prices right now. Here's the same information on regular paper. The previous was on logarithmic paper. Here now is my micro market areas. You're starting off with the index that gives you the range and color coding. Then we have Silicon Valley. Next overall is 37% more inventory than expected. Santa Clara County overall is 31% more, and then you can see each micro market area. And it varies quite a bit. Berryessa actually currently right now has 71% more inventory than you'd expect. And then Saratoga Las Gatos only has 88% of the inventory you'd expect. So quite a bit of range. Same concept in San Mateo County at 143% with a range of a low of 95 and a high of 152. And then Alameda County, for the first three slides, I only have countywide data. And it's at 41% more inventory. So all three counties have more inventory, and the numbering and the order is the same. I try to bring in some separation so you can jump to the county you're interested in, and you have the benchmark over here on the right that you can find it pretty easily. Look at the number of offers, also blue in color, so that means less offers than normal. And you can see the only area that has more is Los Altos, Palo Alto, at 15% more offers than typical. And that's the only one that's at 100%. Everybody else is quite a bit below 100%. This is the days unsold inventory. So this is the ratio between the two. So the supply demand balance. Look at these numbers, 200%. So that means that Milpitas, Berryessa, Blossom Valley, Santa Teresa, the speed of the marketplace now is half the speed that it normally is. It's taking twice as long to sell all your existing inventory. You come down to, and that's the highest number I'm seeing in any area at all. And that's sort of interesting because it wasn't that many weeks ago that area was on fire. You come down to San Mateo County and the highest is 236, so it's a little bit higher. So it's not, I'm not going to say it's not uncommon. It's still very rare. And then in Alameda County is at 67. You know, having 2.5 times slower marketplace than you typically do is pretty significant. Now, despite the market being slow in those areas, Milpitas still has 36 days to sell their inventory. So it's just, that tells you how quick Milpitas typically is. So if it was 2 1/3, so it's somewhere around 15%. Normal would be 15 days right now. So normally you'd sell everything out in 15 days. And now instead you're taking a month and a week. So you're taking 5 weeks to sell everything. And I forgot what the area was. Redwood City. So Redwood City is at 6 days. And that was 2.5, 230, call it 2.5. So that would be somewhere around 20 days. Yeah, somewhere around 20 days is where Redwood City would typically be at this time of the year. So it's, you know, significantly slower and you didn't notice it. Those are still reasonable areas. A lot of the country considers 3 to 6 months to be normal inventory. And here we're talking about a month and a week could be significantly slower than normal. So that's why it's important to understand what's going on in real estate. Real estate's a very local event. Here's the marketing time for the 75th percentile. You can see these numbers are all still very respectable, frankly, to be able to sell you 3/4 of your sellers that do sell are selling in under 3 weeks for the most part. Most of them are under 2 weeks or just over 2 weeks, 15, 16, 18 days. So, pretty much across the board, it's under 3 weeks. Well, let's look at Silicon Valley overall, 18 days. So 2.5 weeks. Santa Clara County, 16 days. That's only 2 days more. San Mateo County, only 16. And then Alameda County is a slow at 3 weeks. So to be able to say that 2 of our 3 counties are selling out in just over 2 weeks and the slow one is selling out in 3 weeks is pretty incredible. And that's not selling out. That's 75% of the sellers are selling in that time frame. but still 3 out of 4 sellers selling in 3 weeks. Here's the ask price reductions, still fairly mild. We're starting to pick up a little bit more blue. You can see Saratoga Los Gatos at 1.8%, San Mateo County Coast at almost 3% price reduction, but Foster City 0% price reduction. Campbell, Cupertino, Sunnyvale at 0.1% price decrease. So, price decreases are still fairly small. Here's the frequency of price reductions, not very common, so that would favor the seller. And across the board, the biggest number I'm seeing is 30%, which isn't even 1 out of 3 sellers are reducing their prices, and that's in the San Mateo County Coast. Here's the buyer overbidding. This number, again, is lagging by the duration of escrow, but these numbers are magnitude, and this is average overbid. So your average overbid is 8.4% for Silicon Valley, that's 7.8 in Santa Clara County, 8.2 in San Mateo, and the high one being Alameda County, which is a little interesting because that's got some of the longer marketing times, but the most aggressive overbidding. This is the frequency of the overbidding. Alameda County at 73%. San Mateo is a little bit more common at 72%, and Santa Clara County is the most common at 74.2%, and Santa Clara County is the most common at 74.3%. So all of the three very close together, call it, 73 to 74%. I mean, you can't get closer together than that. Here's the appreciation. You can see the hot areas in red and the cooler areas in blue. It's basically the more affordable areas that are in reasonable commute distance that have had the highest appreciation since 2015. And frankly, those are the areas that have had the highest appreciation since 2020 in the pandemic. Here's the sold price, and the middle number is the median number. The number on the left is the cheapest 10 percentile you'd expect to find. The number on the right is the most expensive 10%. So basically what this does is it allows you to know the price range in every given micromarket area. The redder the color, the higher the price. The bluer the color, the less the price. Here's a table summarizing everything. So you can start on the left-hand side in your micromarket area, come over here on the right-hand side, and you have the price range. I am missing the 3 graphs with the monthly mortgage payments. I had other issues with getting the presentation together. I will try to bring back the payments. I have a project for this week, so it'll probably be at least 2 weeks before it comes back. But you can see that your days on sold inventory compared to normal is blue, which means we're across the board much slower than you would expect the market to be, even though those times are still fairly red. The one exception is the Hayward San Leandro area, and it's the hottest at 103 days. So it's starting to get up there. But, again, that's 3 months, which would be the hottest that many areas in the country are considered normal. And that's why they quote in months and I quote in days. Here's some table showing the number of offers that accepted. The key takeaway is we were the slowest out of the last 10, and even the slowest out of the last, or not the slowest, but the fewest number of offers out of the last 25 years. Then we were in second place, then third, and made it into fourth. But now we turned around and became third place. And the year we're now doing less offers than last year. So the 2 years that are less are 2020 because of the pandemic, 2022 because of the price adjustment that we went through. So the fewest number of years was 2020 because of the pandemic. Then it was 2023, which was after the price adjustment and everybody was still concerned. And then this year, and then last year. So they're not great years that we're doing worse than we are this year. So the fact that there's only 2 years that were slower than us is not saying very much based on the 2 years that they were. Here's the numbers for each of the counties, Santa Clara, San Mateo, and Alameda County, or Silicon Valley as a whole. There are some significant takeaways here. Inventory is up across the board, and this is new listings. So you basically have 1% more new listings. You have 9% more active listings. So that's what's available for buyers to buy. And meanwhile, your offers went down by 6%. Now, noteworthy is San Mateo County only went down by 0.7%, less than 1%. Alameda County went down by 8%. Santa Clara County went down by 6.6%. These two counties, Santa Clara and Alameda, are much bigger than San Mateo, so they really drive the marketplace. But it shows you that even the three counties that make up Silicon Valley don't go in the same direction or the same magnitude. Then your days unsold inventory has increased 66.4 days, 5.8 in Santa Clara, 3.1 in San Mateo, which is almost nothing, and then 9.1 in Alameda. But keep in mind, I consider anything over 5 to be significant. So 2 of the 3 is significant, and San Mateo County is an honorable mention. So that's a significant slowdown. And it's basically you have more inventory, fewer offers, making the turnover rate longer. We have been talking about the Silicon Valley real estate marketplace. We will be talking about the Greater Bay Area, 13 counties and 5 regions next. I'm Richard Calhoun, real estate broker with Creekside Realty. My contact information is on the bottom of every slide. I represent buyers or sellers in single agency transactions anywhere here in Silicon Valley. You can get to my YouTube archive channel by typing the blue link here, or you can type in the shorter green route URL. The shorter green route URL also gets you to the live presentation Saturday morning by adding in 2025 at the end at 9 a.m. You're welcome to join in and ask questions. If you want the handout, it's the green route URL, the letter H plus the year, month, date code. So it'd be the green route URL H 2025 04 12. And any past specific episode, if you know right off the bat what episode you're looking for, you can go in there and type it in directly or go to the YouTube channel. Appreciate its subscriptions and likes. It doesn't cost you anything, and it helps out get the word out to more folks and makes the effort that I put into putting this data together worth it. So I'd really appreciate some likes and subscriptions if you're not already doing so. Here are the 5 regions that we're going to be talking about in the same 10 years, 2015 through 2024, the base 10 years. Here's inventory. Inventory across all 5 regions is up in the upward direction. Santa Clara County, Silicon Valley is probably up the most, then probably North Bay, then the Central Valley, and then we're getting down in the minutia, but probably the cities, and the flattest is probably Santa Cruz. Here's the number of offers. Basically, all 5 regions flipped over and went down. The one exception, and it's hard to see, might be the Central Valley. It may have gone up slightly, or if it rolled over and really didn't go down at all. So the Central Valley appears to be, at least initially, not following the trend of the other 4 regions, which is a little bit surprising, but it might be marketing, it may be habits, it may be any number of reasons. Here's your days unsold inventory. All 5 regions appear to be going up. Even the Central Valley appears to be going up ever so slightly. I cannot tell from North Bay, but I would suspect it went up underneath the blue line. Here's the marketing time, the 75th percentile. You can see that Silicon Valley is the first one to turn around and the only one that really has turned around. The other 4 regions are probably bottomed out. You know, the cities improved a little bit this last week. The Central Valley improved a little bit this last week, and so did North Bay, but they're all getting fairly close to flat. This is the seller's ask price reductions. Coming down would be larger price reductions. Clearly coming down in the Central Coast. The North Bay is coming down. Silicon Valley is coming down. The cities is coming down. But Central Valley is bucking the trend and going up. So Central Valley is still on fire compared to the other 4 regions. This is the seller's ask price reductions, increasing in 4 of the 5 regions. Central Valley is basically oscillating and basically flat. So the other 4 regions are all increasing, with the Central Coast being the least. Probably Silicon Valley was the first to turn and the most up. This is the magnitude of overbidding. So the competition the buyers are sensing. The Central Coast is going more overbidding. Central Valley is flat. North Bay is flat. Silicon Valley is rolled over and coming down, and the cities, San Francisco and Marin, is rolled over and coming down. This is the frequency of overbidding. Basically the same pattern for the most part. Silicon Valley is rolled over is flat. Central cities is flat. North Bay is rolled over. Central Valley is going up, and Central Coast is going up. This is long-term appreciation. Silicon Valley's had the highest appreciation at 200%. That's all 3 counties. The city of San Francisco and Marin has had the least appreciation, but it's coming up fairly significantly recently. And I need to pay attention to it. I believe from glancing, Marin is doing much better than the San Francisco is. Here is the price of the different areas. You can see that the cities is not up to their previous peak back here in 2022. Silicon Valley is right at its peak, and that's because you got all three counties involved in there. Santa Clara was above their peak, but San Mateo and Alameda County were below, so all three are right at their peak. The Central Coast we're just below their peak. North Bay is just below their peak, and Central Valley is just below the peak. So the peak pricing was still that 2022 market before we went through the price correction. Here's the table that we started off with, and let's look at Marin and see if that's in fact true about the appreciation. So here is the appreciation. So it's not true, because San Francisco is 61% appreciation. You have 61% appreciation, 62% appreciation in Marin, and only 58 overall, which means there has to be a shift to the lower expensive county. The lower expensive county, when you combine, is Marin. So Marin is making up a larger share of the marketplace. So even though Marin's median has increased 62%, when you bring in the lower price, it gets diluted. It dilutes San Francisco and pulls down the overall to 58%. And that's how you can have a number of 58% for two numbers. Right off the bat, you'd expect a weighted average between these two. But because Marin is a cheaper county than San Francisco, more transactions in Marin pulls down the price for the two combined area. And that's how you can have things like that happen. And with that, we're back to the beginning slides. So these are the chapters you can go to and jump to the timestamp. And thanks for listening. Take care. And again, I appreciate the likes and subscriptions. Take care. Bye for now. See you next week.